welcome, Anders. I hope you've had a nice summer.
Most definitely.
Great. Enjoyed some good Swedish weather, we hope, this summer.
We had fantastic weather in Sweden and a lot of foreign tourists coming for this coolcation thing.
Perfect. Lots going on, so we jump right into our update. With all eyes on the Trump and Putin summit today, there are a lot of things that would need to happen to lead up to a potential peace deal. Can you outline a little bit of those for us and maybe talk about the implications going forward?
I do think that we've seen a couple of points coming up. There has to be a ceasefire before there is a peace. There probably has to be a land deal where some regions that are already occupied by Russia comes to some type of at least medium-term solution. There has to be very broad security guarantees for Ukraine, either in the form of support from US and Europe, or probably in combination with fairly strong economic support for the Ukrainians building up their own defense after a potential peace deal. And obviously there has also to be a very broad-based reconstruction of the Ukrainian country and economy. That can obviously only happen in some kind of roadmap for Ukraine to in the longer run join the European Union. Obviously, there are arguments against the peace deal now. There is a lot of arguments for Putin staying in a very strong position in Russia and using the war to facilitate and give him arguments to keep this very, very tight control over the Russian political and economic system. But the sanction regime is hard. It could potentially, if the negotiations breaks down, become even harder, and that could be an incentive for Russia. And I think also Putin are today in a position in the public opinion in Russia where he has fairly strong support, which means that he potentially actually could have room to maneuver and make a compromise. It is clearly a long-term conflict in the Russian framework of thinking. They clearly doesn't want to have a strong, economically prosperous and Western-oriented Ukraine on their border. So Putin has shown historically that he is unpredictable. Maybe Trump has opened the door for a starting point for a broader negotiation. But obviously this is something that time will have to tell.
Okay, if we turn to the US and we think about, we've got inflation on one hand and we've got some of the job market numbers coming in on the other. If you surmise for us a little bit the US economy and where you think the state of the US economy is today.
So I think it's pretty clear that the first half of this year has been much stronger than people expected. GDP numbers have been better. The consumers have held steady even in a fairly turbulent economic environment. The stock market has obviously been spectacular. Interest rates have stabilized a couple of tenths of basis points above 4%. So I think the first half of this year has kind of shown US resilience. We have leading indicators for Q3 and Q4. If you look at the PMIs or other leading indicators like consumer confidence, we don't really have signs of an imminent slowdown or a recession in the US economy. Clearly the labor market has slowed down. There are many factors there. Demand has been a bit softer on the labor market. So I wouldn't be that worried. The US actually needs to see a slower employment growth to have wages coming down a bit below 4%. It's been quite positive that unit labor cost, wages adjusted for productivity, actually has held up very well. The latest number is only 1.6, and as we know, a 2% inflation target is actually in line with the 2% increase of unit labor cost. So the US economy is in a pretty good shape, particularly if we compare where we are to what all the pundits have been saying after the turbulence around tariffs. So a fairly healthy US economy. Inflation has come up a bit, but let's remember that people were talking about a massive increase of inflation in June and July, and we haven't seen that in the numbers. The PPI number came out a little bit on the higher side, but we are not going back to an inflation close to those 7 or 8% that we saw a couple of years ago. We are in a situation where inflation expectations are balanced. We have a bit of softer demand with an open output gap and a low capacity utilization. And we also have a labor market that is, particularly if we look at unit labor costs, in line with inflation coming down to 2% within 12 to 24 months. So the US economy, I think, is doing pretty well.
Good. And turning then to Europe and to our home market of Sweden, we've had several developments over the summer. Would you like to share some of the thoughts on those developments and I guess even their inflation and wanting to keep the economies growing and moving?
So yeah, Europe's economy has also been a bit stronger in the first half of the year than expected, but here we're talking still of Germany, Italy, and France growing at a very, very low pace compared to the US. The labor market has remained solid. We have seen the Nordic countries coming in with a bit of softness. The recovery in consumption that we're all expecting for the Swedish economy has at least been postponed. So we see wage increases, we see a bit of optimism in the retail sector, but the drags from lower house prices and higher interest rates seems to be lingering a bit, at least during 2025. We are going to see a new budget in a couple of weeks here. I think the government will present a fairly expansionary budget with tax cuts for the household, additional spending on defense, welfare, and also the police and other measures that are necessary. So for 26, I think the economy has a bit of support from rate cuts, a bit of support from fiscal policy, and also from a fairly competitive exchange rate. So I think we can stick to the scenario that the Swedish economy is in a rebound, and I do think that the temporary inflation numbers that we've seen during the summers due to traveling is not the major factor for the Riksbank. ECB, Fed, Bank of England are going to cut the rates during the autumn, and I'm pretty certain that the Riksbank will follow through with one or two more rate cuts. Mm.
We'll be looking to see that then. Looking at emerging markets, we've also had a lot of happenings in China, a lot of news out of China with the potential slowdown, and then also actions taken by the Chinese government. But and then also India. Would you like to comment on both China and India a bit?
Well, it's pretty clear that China has been very resilient. The export numbers for the US in April, May and June has been very, very weak, but China has been able to redirect its export. We saw export actually accelerating from 6 to 7% growth during the summer. So China has a fundamental strong competitiveness. They've been able to cut export prices. On a trade-weighted basis, the currency has depreciated a couple of percentage points. Interest rates are coming down. Both the 10-year and the 2-year are on historical lows. And there are also a bit of fiscal support. And yes, the real estate crisis is obviously ongoing, but we're getting closer to the inflection point, and interest rates will be a bit of helpful. And I do think that we are going to see this additional fiscal stimulus from the Chinese government. With their very high growth rate and low real rates, you actually have a bit of good and positive debt dynamics that gives them a bit more policy space. And when you look at the very, very low inflation, it's clear that they can do more on monetary policy to support the economy. So far, I would say that the Chinese economy has weathered the tariff storm much better than we expected. Obviously, India struggles a bit now when we have this tariff turmoil. I do think that from a broader geopolitical point of view, it is necessary for the US to keep a strong bond to India. India is the key player in Asia, particularly if we want to rebalance against China. So I think this is a deal-making process where Trump is kind of coming with some tough and hard offers. But at the end of the day, I don't think that tariffs on India will remain high. They will come down. And given the resilience that we've seen in the Indian economy, and remembering that export is not been driving growth in India, if you compare it to the historical pattern of China, India is a normal economy in the sense that 2/3 of growth is actually consumer-led. So I do think we could be fairly confident in the Indian economy remaining resilient also going forward.
That sounds like a cautious optimism on both China and India.
Yeah, I think particularly if you compare it to the newspaper stories during spring and early summer. The trade war and the tariffs have been the dog that didn't bark. It's a bit surprising that we've seen so moderate impact, and it's very surprising that Chinese export has held up so well. But so far so good, I must say.
That leads us into investors and the stock markets. We have the S&P, we have the European stock exchanges, and then also for emerging markets. What do you see on the horizon what do you see now, and what do you see on the horizon for the fall for investors and the stock markets?
So if we look at the second quarter reports, and we basically have the US stock market now, Nvidia is coming, but most of the big companies have reported. Sales growth was very healthy. We also saw earnings per share growing rapidly on the back of fairly solid profit margins. Obviously, the strong AI-related companies printed even stronger numbers with an EPS growth north of 20% and sales growth north of 10%. So there is a kind of a special factor in the US market where the huge AI investments that we see in 23, 24 and 25 is starting to materialize, hopefully, in terms of creating a lot of shareholder value. If you deploy $600-700 billion of US dollars on a vehicle where you have a return of 30, 40 or 50%, you're obviously creating a lot of shareholder value. So I think the US stock market is strong. If we look at Q3, Q4, there is no signs of a weakness in the US economy that would make those earnings seasons different from second quarter. And for the outlook for 26, we are in a situation where nominal growth in US will be fairly decent. 10-year has come down to 4.25, and profit margins for next year are probably going to expand a bit. So if these forecasts hold up, I do think we still have some value in S&P 500 also going forward. If we look at Europe, the earnings and sales are weaker. The reporting season for second quarter was a bit better than expected, but particularly for Euro area. Sales numbers are weak and profit margins are substantially lower than in the US, roughly around 10%. So there is a much weaker support for Euro area stock markets. We've seen that the financial sectors and industrials have done fairly well. And I think that's good because obviously we're always worried of a financial systemic risk. And I think that risk at the moment is fairly low. And the fact that industrials have done fairly good is good because it implies that they've been able to navigate the tariff worries and the risks on the supply side without any major incidents. If we look at emerging markets, I think China is a very interesting situation. Nominal growth is strong, and basically with this low inflation, it's real growth. We do have a lot of companies where valuation is much lower. It's possible to put up a portfolio with a PE number of closer to 10 and an earnings growth of well north of 10. So the Chinese stock market is interesting. There are some very important geopolitical risks and also some internal risks with China. But the fact that the government has done this big pivot on the tech sector and entrepreneurs, I think is a very positive sign. DeepSeek has created a lot of optimism, and clearly people in companies in China are rolling out new digital business models on the back of DeepSeek. So with the fairly low valuation and the fairly solid earnings growth, I think the emerging markets economies and also the frontiers are a fairly interesting space at this point of time. And the biggest risk in these markets tends to be the dollar. And we've seen that the appreciation of the dollar has backed down a bit. We are on an index level very close to the long-term average. So with the dollar that is not exceptionally strong, and where I really don't see a big upside for the dollar when Fed now in September and continuously during the autumn are cutting rates, I think this is a fairly benign environment for emerging markets.
Thank you. Very good update, and lots of points in there and things to take forward. It's been a good summer, and we're going into the fall now. And you reflected when you came in today that you have gotten a haircut during the summer. Can you tell us what's behind this?
I think my haircuts has been a public issue for decades now. Well, I mean, there are a lot of countries, not the least the US and in Europe and elsewhere, that needs a haircut. There are many companies that are too heavily indebted. So I was just trying to do my part of it and contribute with a bit of a tight haircut to improve the symbolism in reducing your indebtedness in the public economies.
So you're our visual role model for the haircut.
Yeah, it's clearly a signal. It's clearly a signal. You need to do haircuts on your debt.
Perfect. Great. Thank you, Anders.
Thank you.